Welcome, everybody, to another episode of Smokin Bulls, the podcast about business, money, and lifestyle. I'm Tyler.
I'm Dave.
And today we're chatting about our most recent market insights from our chief market strategist, James Thorne. He's got a new one out there. It should be in your email inboxes by now. And we're just going to do a quick chat about what we're seeing in that article. So I guess real top-down view, Dave, what are we seeing here?
First comment would really be that Jim doesn't like Main Street or Wall Street. The way they analyze things, he's kind of on his own path and believes, that the markets have a better sense of what's going to happen and it's not all horrible. So I think the biggest thing he's saying is there's a regime change or passing the baton. So, what does that mean, right? In this situation, he's basically seeing the world in the sense that everything that's happening in the United States, for example, is they're basically trying to get this run by private markets, private industry, private business to drive the economy and less government interference is kind of what I got out of the whole note.
I'd agree with you. And I think that baton passing is saying just that. Yeah, get it out of the government's hands, get it into private industry's hands. It does a better job with it, and it'll be what pushes it forward. So he also highlights in here that, part of that process is up to this point, there's been quantitative tightening, which is the rising of interest rates or the raising of interest rates. We're now in a period of time where interest rates are pulling back a bit.
Right.
And I think his comments are that's increasing liquidity in a market space because money is cheaper to borrow. And he points out that most of the time when you see a market pullback or a sustained one, it's when there's lack of liquidity, not necessarily bad valuations, but lack of liquidity.
Right.
So he's not expecting lack of liquidity in the next year. He's expecting increased liquidity, which should drive markets forward.
He's in there. Bad valuations, not necessarily going to bring a market down, but illiquidity
brings a market down. Yeah.
Any valuations in the wrong way could cause a lot of problems. So definitely. On the liquidity front, though, he sees that a lot of that happening too from kind of the government getting out of its way and basically providing some opportunity, changing some banking regulations so that the private banking system in the States, or just the banking system, starts to be able to lend at a better clip than they were before. So comments about running it hot. So
right.
Yeah.
Right. So that was what we see as what's driving the market forward this year. I guess the other thing that would be driving it is I think he's expecting to see a broadening of what's creating market performance. The last number of years, it's been technology, big tech stocks that have really pulled the market upward. But he's expecting that to start to diversify a bit, I think. And he touches on the AI CapEx, Supercycle, all this investment by capital expenditures by AI companies. And what does it take to keep that AI company going in terms of what they're building? So you got to build infrastructure for these AI companies. You got to build the power demand that they require needs to be created. So that's more of your traditional market drivers, like your construction companies,
utilities.
Yeah, you bet, all that stuff.
Mining,
yes, for rare earth metals, but as well electricity. So that's exciting too. Is that we're going to potentially see growth from companies that we haven't seen that growth from yet.
Yeah, and I think that's kind of the argument that everything driven by AI is fluffy, overvalued, a crash is imminent. And I think Jim here, he's like, no, this just broadens. Like this is the economy. This is how it's going to move. And if we don't build out the structure for this, then we're looking at that kind of thing. And I think his comment too on some of this had to do with, we've talked about this before, with this market cycle, and we've talked with our top managers on, it's this midterm election's always a dicey year, and Thorne's pointing out that our dicey year happened last year. Our market correction happened. He goes, you don't get many years where the market corrects downwards 20% in one kind of short period of time. Very often, and we had it, but it bounced back within a few months, and that's a lot of people were already out or thinking that it was the end of the world, right? So
yeah, we had that that bounced back in, what was it, March, April 2025?
Yeah.
And then the recovery came, you're right, very quickly. Yeah. So are we set and poised now to just keep climbing forward? Because he puts it out there. He always likes to put a point in the sand or draw a line in the sand and make his estimation. He's saying very easily, he's an achievable target would be 8,000 points on the S&P 500 by 2026, with a stretch of 8,400 points. So he's pretty optimistic with the market sitting now just under 7,000 points, I think it is. So yeah, and at 14,000 by the end of the decade on the S&P.
So, I mean, you think about the 14,000 number, and we're what, 4 years, 26 or 7, 20, we're 5 years, call it. Depends if you're starting 2030 or the
end of the year.
Yeah, I mean, you're talking almost a doubling in 5 years, which puts you at a 14% average rate of return from now to then, with a lot of, obviously, as we always talk about, a lot of volatility mixed in there, especially if you're just a straight equity person and that's all you're buying. If you're buying the S&P 500, an ETF, expect massive volatility. The same with the TSX. We don't kind of operate that way because we tend to have quite a balanced portfolio that doesn't go up and down as much, but we definitely overweight our portfolios based on a lot of information, and we might be overweight technology, we might be overweight financials. I mean, that's kind of what we're talking about here. And part of his comments is about what kind of portfolios, what should you be in?
What should we buy?
Rate sensitive sectors, especially housing, along CapEx beneficiaries, and that's what you talked about. There's going to be a lot of spending, so who's getting the money? Utilities, industrials, materials, infrastructure. Who's lending the money? Banks. And that's part of trying to open the liquidity in the U.S. market. Is there's a lot of money that needs to be used to kind of build that, and gold, Bitcoin as hedges, right? And so we've talked a lot about mostly Bitcoin, not as much gold. Gold old school, Bitcoin kind of new school. But yeah, I think it's quite an interesting opening January 2026 market insight salvo. So it'll be interesting how it goes.
Yeah, see how it plays out
as the year goes along.
Yeah, and he also is always quick to note, the pullbacks are buying opportunities. He figures we're in a secular bull market, so take every pullback as an opportunity to go in further to the market and buy the stuff we've already really talked about. So that's encouraging. He's not saying, there's a bear market on the horizon here, batten down the hatches, go to safety. He's saying this is your opportunity to take some risk perhaps and get out there. So,
but I think comment on that is, pullbacks is a buying opportunity. Well, that's if you have money. If you're fully invested, then that's buy and hold, and get out if you can't manage it, type thing. But selling at what you think is the top and buying at what you think is a pullback, I mean, you're a genius if you can nail that all the way along. So if you got cash, invest. That's what we always say. But wait for one of these pullbacks. You get a 10% reduction in the S&P or anything, that's a great time to buy if you've got the excess cash. If you're already invested, it's a great time to be staying in until we see things change, specifically some liquidity. There's absurd valuations out there. That's just the way it is in a new
fledgling industry.
And, until we see how it plays out, we don't know what valuation is wrong. Every new thing has goofy valuations until they settle. So this isn't 1999, 2000 at this point. These aren't one-trick pony companies anymore. The Mag 7 are very well diversified in everything, right? So,
in any case, it's exciting. It's a good article. We encourage you guys to read it. If you have any questions about it or how your portfolios should be set up, by all means, give Dave and I a shout or find us on social media. Thanks again for watching. We'll catch you next time.